Hi guys, amazing. We are starting our fourth day at the conference and starting with that with the panel discussion. I'm Sasha Pitkevich. I'm leading blockchain practice at EPAM and I'm going to introduce you the discussion today. And we are going to speak about digital money. The fact is that across Central Asia and the Gulf, digital money is quickly becoming real, not just a concept. Over 130 countries are now exploring central bank digital currencies, and stablecoins have grown past 150 billions globally. Markets like United Arab Emirates, Georgia, and Uzbekistan are already testing new models, especially cross border payments and uh, financial inclusion. Today's discussion is about what this shift actually looks like at the region and where it can bring us in the future. Let me introduce our first speaker, Mikhail Korneev, who is the head of the digital services at Asterium, Uzbekistan.
Greetings, Sacha. Pleased to
Hi,
be here.
Mikhail. Yes, and I'm calling our second speaker today, Jack Saracco. He is head of stablecoins and payments at ADI Chain, ADI Foundation at Dubai.
Hey everyone, how are you?
Hi, Jack. We are perfect, and we should have our third speaker today, David Dudashvili, chief analyst of the National Bank of Georgia. But we had some technical issue, and David is here. Wonderful. So we all are here, and we have 45 minutes to have a discussion. So let me introduce our first question. And when you start speaking, if you want to add something about yourself, about your company, you can spend 1 or 2 minutes about this. So, our first question or our first discussion point would be, how do you see the role of central bank digital currencies and stable coins in evolving in your respective jurisdictions over the next 3 5 years? And where do they complement or compete with each other? And if I may, Jack, can you start, please?
Yeah, absolutely. Hi everyone, pleasure to be connected. Thank you for the invitation to be here. Basically here, what we're doing at ADI is ADI chain is more of a payment and stablecoin native chain. Our view is we have a digital dirham stablecoin on ADI chain, and we've been working very closely with the regulator here, with a central bank regulation and with foreign central banks to see how the stablecoin can actually be completely interoperable and make payments more efficient on the entire cross-border route from the UAE out and from the inflows too for the different broader GCC area and EMEA region, basically. As I see different regions in different countries and jurisdictions take CBDCs and stablecoin stance in a particular manner and a different format. We are seeing how UAE is leading, in a way, this innovation on how the CBUA regulated stablecoin, and it's the first country to actually have their central bank regulating stablecoins more than legal frameworks that are done in different countries where it's not about central bank regulated stablecoin, it's just a stablecoin framework as it is. The UAE has also announced that they're working on their own CBDC, and the idea is to see how those in a future become interoperable between each other while running on chain.
Thank you, Jack. And David, can you complement that? You are from National Bank.
Thank you, Sasha. I think besides being from the central bank, one of the good experience points is that we jointly went through the CBDC pilot project, us and EPAM, so there is a lot to say. But when it comes to stablecoins and the central bank digital currencies, I think it's less about competition and more of a question of purpose. And in that comparison, I would also like to bring up another asset type, which would be the tokenized deposits, because essentially, when we speak about CBDCs, one of the primary use cases back at the times was conducting more efficiently monetary policy decisions. And bringing them to economy without the lag, which we naturally have in the two-tier financial intermediation system. So when it comes to CBDCs, and if those points that I have mentioned in around CBDCs are not the major idea of that introduction, I think then the biggest comparison would be in between the tokenized deposits and the stablecoins there. Now, the purpose of those two is very different, and it's a very tricky question of which should be simulated within the economy when it comes to national currency pegged payment instrument. Now, in that case, if we speak from the regulator side, of course, we care a little bit about different things, such as the power of crediting coming from the two-tier financial system. And another side of the question here would be whether the stablecoins will challenge the balance sheets of the commercial banks, because essentially all the tokenized payment instruments, technically they are done the same, but there are different grades of purpose, supervision, and a lot of different technicalities that I would like to skip there. So when it comes to stablecoins and the tokenized deposits, in that case, I think they will naturally complement each other. In that case, the way I see myself personally within these two assets is that we can leverage the stablecoins issued by the fintech companies or non-structurally regulated entities such as virtual asset service providers as a gateway to the decentralized finance, cryptocurrencies, and the dApps. But when it comes to more of a retail-centered use within the economy, then I think one of the biggest considerations there should be tokenized deposits, because skipping everything aside, they are also protected by the deposit insurance. So it's a very different assets. They might serve the same purpose, but it's a very tricky way to navigate in between them from the regulator's perspective. Although they, of course, from the fintech and the innovators, they might have the different talking points.
Thank you, David. Mikhail, do you have something to add to this?
I don't think that it will be relevant to be something added, because previous speakers just mentioned everything that can be done from the fintech side. So yeah, we understand what we are going to do, what will regulate we receive with the CBDCs and the tokenized assets, and everybody want to discuss this in future question that will take.
Okay, knowing your area of expertise, I will direct Mikhail question to you. How are national payment systems adapting to integrate blockchain-based instruments? And what are the biggest technical or regulatory bottleneck you're facing?
Yep, if we are talking about the national payment systems, they are right now in Central Asia are already adapting. So right now there are many work is done to become the regulated sandbox that will create the CBDC or tokenized assets in the economics of the Uzbekistan. I think one of the biggest misconceptions is that the blockchain infrastructure and national payments are somehow competing with each other. But in reality, they need to work in the same way, so they need to integrate, and in reality, they are becoming increasingly interconnected. So national payment systems already provide trust, scale, and broad user adoption, but blockchain technologies can add new capabilities, such as programmable payments, tokenized assets, faster settlement, and efficient cross-border. So yeah, in Uzbekistan, system like Humo and broader banking infrastructure already play central role in everyday payment. So the next stage is not replacement, but just the integration of this technology.
Okay, thank you, Mikhail. David, may I ask you, what are the most promising, in your view, real-world use cases for tokenized assets in your region today in Georgia? We heard about tokenized deposits, probably that's government bonds, because we hear about that before while we were doing the project. Sometimes commodities, sometimes real estate, and which are still more conceptual than practical.
I think that's a very great question, and the answer of that question would very much depend on the region that we are discussing. But I will censor around Georgia specifically because the National Bank of Georgia, when we concluded the central bank digital currency pilot project, which is the subject of further clarifications and the public notes and so on, etc., we've moved to the strategy of introducing targeted sandboxes. So what that means is that currently the real estate, the tokenized real estate, or specifically the tokenized equity of real estate, is a very big thing, especially in countries such as Georgia, where we have a quite huge inflow of FDIs in around the real estate domain. Another thing is that we truly believe in the tokenized governmental bonds. Either way, it might be also the corporate bonds, but strategically for now we are exploring the tokenization of the governmental bonds. And there are numerous instruments that we also explore. It's the tokenization of certificates of deposits. We explore the prospects of the tokenization of money market funds and so on, etc. So in general, it's just the peak of the iceberg when we speak about the tokenized instruments itself, but what we can build on top with the smart contracts and the dApps or the centralized applications, there is such a huge potential in the DVP operations that we actually jointly explored through our pilot session. So I think overall it's the assets themselves that bring the value, but also there are the products that we can build on top, right? Because I don't want to go into the obvious market activities such as the marketplaces, issuance services, and so on, etc. But in general, I think on a business model wise, the biggest one in the context of potential feels like it's real estate and the governmental bonds for now.
Thank you, David. Jack, how that's in Dubai?
So that's an amazing question. We are seeing demand all over the place, as David mentioned, in real estate, to be able to tokenize real estate assets. We're seeing large corporations interested in tokenizing their investment opportunities in real estate to be able to put them on chain and directly source liquidity from every part of the world. The one before it was more closed into different regions and local investments. Now, by tokenizing these assets, either a complete asset or tokenizing the square meters or square feet, you can definitely have investments and investors from every side of the world bring on stable coins to be able to pay. On a different note, we see the entire demand for the financial sector interested in tokenizing commodities such as gold, silver, once again, to in a way make a either stablecoin or a tokenized asset against those commodities and assets to be able to trade them 24/7, 365 days a year, completely on chain. And once again, I think that the main purpose of this is opening up the markets for the international level, not for the local environment we're in. So we see how crypto has massified and distributed the entire investment opportunities that before weren't possible. So we see tokenization of invoices, tokenization of vessels, tokenization of real estate, tokenization of gold, silver, and commodities overall, that right now we're not segregated and not just enabled for one jurisdiction in particular, but for the entire world running on chain and directly sending stablecoins and being part of that, those either vehicles or investment opportunities or either stablecoins against tokenization of bonds or different financial markets. So we're seeing here how the entire tokenization system is, democratizing and opening up these opportunities for the entire world population.
Thank you, Jack. We are coming to the integration questions and we'll hear about that later. But now I want to invite Mikhail to tell us about the products in Uzbekistan. I mean, I know about real estate and tokenized gold, but Mikhail, I think we want to hear that from you.
Yep, so if we are talking about the products in Uzbekistan, we here at Asterium have already provided the stablecoin that is called Humo, that is founded by the government bonds. But also what Sasha had said, yep, some time ago, approximately a month ago, we have launched our own tokenized gold. which is called AUZ, which means Aurum Uzbekistan. So, yep, in Uzbekistan, there are massive culture about the gold. We have the wedding, and the most important part of the wedding is right now is the golden ring, and also some of the things that called ismahar. That is the thing that's given to the bride before the wedding, and gold is a part of it. So right now we are working on the culture that people won't give the real gold, but they will give the investment opportunity with the tokenized gold. So this will be the future of the real world assets. And also right now we are working on another project. I don't know how can I clearly tell about it because NDA is one of the main things in the company, but I will say that we are working on the tokenization of the real estate because in regions we have problems that when building is in the construction, sometimes it can be some not good legal schemes and people are worried about their money. So the tokenization of the construction site will help people to be more sure of the investments.
Thank you, Mikhail. And we are slowly coming to a little bit more technical questions because now I want to bring a topic of innovation, but in a flavor like, guys, I want to discuss, I want you to tell your point of view of how do you balance innovation with financial stability while you are introducing all these new products, because well, somehow you interact with your users, and how do you like total crypto, most of the users are not really ready for that, and when you're speaking about retail cases and something, David, can you start please?
I think when it comes to the financial stability, we as central bankers tend to be the most risk averse, and in that case, it also naturally translates into being careful with introductions, researching sometimes even years around the subject to hedge the risks and introduce the products in the supervised, in the very complex oversight with the prudential supervision and so on and so forth. So overall speaking, I think that's something that is crucial for the general stability of the economy within the country when we speak about the especially retail sector. So in that case, I think we've been gradually working in introducing the products to the economy through the targeted sandboxes. So in that way, we run the novel products into very strict caps, in a very strict oversight condition to research whether that would have any influence over the monetary policy, any influence in around the debt distribution to the retail sector and the public funding when it comes to the governmental bonds, for example, which is something that we need to also consider, and the general exposure to the financial stability of. And in financial stability, we have to also consider the intermediation, because a lot of business models that up to this date were conducted and brought to the retail or the wholesale sector was delivered through the banks. With the growth of the decentralized finance and with the growth of the fintech, those services and those values have shifted toward the less regulated and I would say less concerned parties in around the financial stability subject. So in that case, I think as a central banker, I would say that we are not the best in the context of the speed of introduction of anything that we've been covering at this stage. But with the careful discovery that we conduct with parties such as my colleagues on the panel, we tend to find a way how to make any introduction in the safest manner possible, at least at the initial stage. So maybe that covers that subject.
Thank you, David. And Jack, what is your point of view? Like how it is at ADI?
So I completely believe what David's saying, being we see central banks being a bit obviously slower and less risk or more risk adverse than any other stack of the entire financial ecosystem. That's very clear and obvious why they do. Is that at the end of the day they're the latest or at least the bottom line regulator of everything. We see how banks' appetite for stablecoins is growing massively, not only in the region but in the entire world. And we've seeing how banks are having the taste of stablecoins. Either some banks issuing their own stablecoin, some banks asking for stablecoin guidance and integration on the stablecoin route. We see here in the UAE, for example, that FAB Bank will be having its stablecoin, which is DDSE, which is the Dirham stablecoin, and it will be offered to the users in some manner. So you're seeing how banks are getting into the entire stablecoin route. Logically, here, as a stablecoin is regulated by CBUAE, meaning the central bank of the UAE, then there is that layer of a regulator approval and framework in place for them to grow. I do believe that if there's no framework, if there's no sandbox, if there's no actually robust infrastructure for this to grow in, then there's no 10-year project of this. So I think that's why most of the banks have been very skeptical during the last few years in adopting stablecoins, because they didn't understand what was the ultimate risk involved in this. And now you can see that once stablecoin payment globally became as big as they are, which right now I think it's around 300 billion in total, and that's only of open loop stablecoins. There are multi closed loop stablecoins that still are increasing the entire AUM box. Once those players start to connect with each other, we're going to see a massive rise in the entire stablecoin operation between banks, cross-border banks, clearing houses, for the entire operations to be seamless 24/7 with no cutoffs, which today, though, that's a very big inefficiency overall through the entire banking rails. On the distribution side, you see that fintechs, wallets are the first one to be the innovation hub for for the distribution to actually happen. They were the pioneers listing the stable coins and actually enabling retail users to be able to do it. I think at the end of the day, for the usability to happen and for the last mile, is abstracting as much as possible for the user all the back-end operations of why stablecoins actually work for international remittance or remittance purposes. The more you abstract it and the easier it is for the user to manage their own stablecoins, is how the stablecoins would actually rise and penetrate the mass global market. Right now, some non-custodial, self-custodial wallets are having a hard time, but with complete account abstraction, either on the custodial system or non-custodial system, I think that's going to change very rapidly in the next few years.
Jack, thank you. Mikhail, would you like to add something? Uzbek
Yep.
perspective.
Yep. From the Uzbek perspective, if we are talking about the innovation versus the financial stability, I think that balance should not be viewed as innovation versus regulation. Real challenge is creating environment where innovation can happen responsibly. So if we are talking about the future, regulator must create the environment where business can adopt to the rules, and they can adapt to the rules only if they understand them. If the regulator do not create the regulator sandboxes where business can do the mistakes, they will not create the new technologies and innovation may not be possible. So innovation must be done, but it must be not so strictly regulated directly by the regulator. And if we are talking about really Uzbek perspective, I can say that Uzbekistan is really good at it because some of the projects that we are running at Asterium are right now in the regulator sandbox, and we are finishing them. We had done some researches, we have created the product, and right now we are changing the laws because it was possible to create the product that was not previously.
Thank you, Mikhail. And now we are coming to the integration question. And Jack, I will touch it to you and then we'll ask guys to add. Is how do you think, how important is integration with existing fintech layers such as open banking, digital identity, API ecosystems for the success of blockchain-based financial services? So
So
yeah,
I think
it's
it's fundamental that in a way that seamless integration between stablecoins and fiat and stablecoins should be as seamless as possible for actually users to see the benefit. If not, you're getting into the stablecoin sandwich type of a mechanism where you on ramp in one country, you off ramp in another country. At the end of the day, no one is perceiving the value of moving funds around internationally with minimum cost because there's always a leg that wants to charge a something. So the faster and the cheaper it is to on and off ramp, and I see that stablecoin issuers are the fastest way to on and off ramp in the planet. By doing that, you enable the entire cross-border system to work. If you're going directly through an on and off ramp and then directly through a different on and off ramp, then the middleman in between, the multiple middle hands in between, is what makes the last mile payment maybe even same prices today going for a cash network system or through a different remittance corridor, not usually using stablecoins on the back, but actually running the intra banking system. So I believe that the entire banking layer and the entire fintech layer are a fundamental for the entire distribution of the stablecoins. Banks being the mostly the converters of fiat, local fiat to crypto, and fintechs being the massive distributors of saying we're connected on multi regions, we're available to do withdrawals and redeems 24/7, and that's exactly where stablecoins can run free, and that's where the end user at the end of the day sees the benefit of using a stablecoin to pay. I think that on the distribution side for users actually to see the benefit of stablecoins is where pricing comes along. We see that retail are very prone to different pricing schemes. You see that cards being one of the best use cases for a stablecoin consumption. You see how rampant they are. You see the top three in the crypto industry. Their volumes are killing it and increasing every single month. So you see how that became the de facto use in a way of stablecoin usage and consumption. Because at the end of the day, if you don't have an interesting rail to consume the stablecoins you have, then why would you get a stablecoin in the first place, basically? So once the user starts seeing the benefit, paying abroad, paying international with low fees, that's exactly where it's going to come. So the entire tech infrastructure built from fintechs, from banks, from chains directly, and from stablecoin issuers have to work in tandem directly and completely seamlessly integrate between each other for that to actually for the benefit to actually reach the end user.
Thank you, Jack. Mikhail, how is Asterium like thinking about integration with the traditional financial players and traditional financial interfaces?
Yep, I can say it from the perspective of Asterium, and I can say it from the perspective of a normal user. So if we are talking about the crypto, you must be a crypto enthusiast to understand what is a wallet, what is a chain, what is the gas fee, and etc. So if we want to scale the crypto, we must integrate with the existing fintech because any normal user want to use their daily banking app, but right now, if we are talking a blockchain, the blockchain is a technology, and CBDC and tokenized assets, etc., should become some kind of payment method inside of their daily banking app in order to increase this volume. Because nobody wants to dive deep inside. They want normal UI UX, and they want to understand that their money coming faster. So from the crypto perspective, we can add different instrument for the normal users that they even won't see, but it will create the seamless payment, the momentary settlement for the business users, and etc.
Thank you. David, would you like to add something?
Yeah, I think my co-panelists have covered that subject comprehensively. Just one thing from my perspective that I wanted to add. There is no question about whether the openness of different ecosystems should coexist and have integration bridges, because silos actually create a lot more frictions than you know. But another point is here that sometimes it doesn't depend on us, neither innovators, neither the regulators. In a different countries, there are different degrees of competitions. And sometimes, well, we have a conversations about integrations, but isn't there the question whether the banks want to integrate with WASPs or they would prefer to move the custody of crypto assets, for example, to their singular ecosystem where they can actually upscale and I would say build a lot more products that would essentially challenge the, for example, virtual asset service providers in the services that they primarily propose. Or on another side, the subject is that when it comes to integration, we have some success cases in Georgia. Just recently, two of the biggest banks have integrated with virtual asset service providers, which means that, for example, you can now see and trade seamlessly from your banking applications through the WASP digital currencies. Although, since there is no custody involved at the bank, the point is that there is not much that you can do. You can either way sell or buy the instruments themselves. But the point is that the virtual asset service providers, the open banking ecosystem participants, the governmental service participants, the commercial banks, and whole financial institutions are actually exploring where they can benefit, but also where they can move into a new degree of competition. So from the regulator's perspective, I would say, of course, no to silos and let's open up the ecosystem, but in a risk-averse manner. But of course, it not always depends on us, right? Regulators. It's very much of a conversation of will from the participants themselves.
Thank you, David. Guys, we have time for 2 questions. And the last question obviously would be about the future. I have and I'm going to ask one more question. And yeah, our audience knows me well. Some of you know me too. So I wouldn't be me not asking this question. And that's basically, how do you see the relationship between public blockchains and permissioned private networks evolving in national or regional financial infrastructure? So, are your solutions are going to integrate with the public blockchains? How much of the public blockchains you want to see in your ecosystem, and how you're looking at that? And Jack, I will start with you if possible, because I know
Yeah.
that ADI is listed in near intents.
Yeah, correct. So ADI is a permissionless chain. We are also having module L3s that are being built on top of us. This is mainly based on a demand-driven approach where we have different banking clients and different payment institution facilities that are looking to have their own private network in a way running internally as a proof of concept within the movement of the funds of their own financial infrastructure, and eventually moving to different, more permissioned, or more permissionless systems. I'd say that, as David very well mentioned, the silo effect of everyone having their own silo system is what has proven to not scale in a way, where we see how being modular on a chain or directly being able to have compatible L3s running in tandem with each other is what makes something like this scalable internationally. If everyone were to have their own banking network and connections with different other private networks would be impossible, or would take very unique and custom integration, then there's no messaging between these networks. That's definitely going to fail, and that's something that won't drive any single adoption. I do see how most of the banks are concerned about key points like privacy, like AML, KYC, and the entire licensing perspective on their side, which they're clearly regulated entities in every single country they operate. So we envision having, in a way, a hybrid model where we adapt to financial institutions, and we are adapting the technology for these institutions to be easy to integrate with their existing tech stack and with their existing, in a way, KYC and AML regulations in place, so we can grow from then on. Because if we see the entire financial market as we see, crypto is very small compared to it's tiny dust compared to the actual banking a flow of funds and actually banking payment system. So it's less of bridging the entire banking system into crypto modules that have been done. Is more about adapting the blockchain directly on how it is, serving the purpose of where the money is being held today, and providing in a way the tech layer for that to occur and for it to be scalable enough, not only locally and locally per jurisdiction per country, but a increase in a geographic manner, which today that's not possible.
Well, love that answer and love the perspective. David, would you add something to this? Probably specific to Georgia.
No, I think as of now, in Georgia, we have rapid growth of the adoption of public networks, especially in the context of the virtual asset service providers that actually offer the crypto services and crypto products to the retail sector. Less so on the private networks, but in the context of expectations and my personal opinion, I would say that it will very much depend who will target what digital assets and instruments. Now, when it comes again to the traditional finance, and if we speak about the financial intermediaries such as banks, I think one of the developments that we should expect in the future, presumably, is that they will more research the private networks and the consortium networks in a way to be as close as possible to the current established AML regulations and so on and so forth. But also the interoperability that would make a lot of sense for them to coexist in a single, say, blockchain environment in the form of consortium. Now, when it comes to the integration with the public networks, then the question is for what purpose and to use what product for what reason. And here again, I mentioned previously that, well, the practice is that there are virtual asset service providers that actually offer the primary gateway to the decentralized finance public networks. There are different regulations, different requirements for the users, and the different activities that are supported. On another side, the general idea is that although the crypto environment has become more mature and that the regulators and traditional financial institutions have put a lot of effort into adopting the blockchain and DLT, whatever. The idea is that still up to this day, especially in the region and especially in Georgia, the institutions are exploring to target what product for what reason and for what purpose. And in idea, that is something that we will have to look closer in the following year or two to see how the ecosystem in general will mature and which participants would prefer what assets to offer to users.
We are coming to question of the future. Let's us just hear Mikhail's perspective on the connections to the public chains. And Mikhail?
Yep. So if we are talking about the public and permission blockchains, I strongly agree with Jack that the hybrid approach is mostly suitable because public blockchains are stronger for the liquidity, for the innovation, for the global access and the market distribution. On the other hand, the permission or the blockchains are suitable for the national infrastructure, institutional settlement, regulated custody, and central bank level users. So if we are talking about the hybrid, there must be companies like Asterium or other centralized exchanges that can be breached for the users. And so we are really just talking about this use cases as said David, because locked blockchains or permission blockchains are suitable for the country and the public blockchains are suitable for the international environment. So regulator, some kind of breach, and this mix can create cross-border available and at the same time regulated in the country which is great.
Thank you, Mikhail. And so our last question, because unfortunately, despite the fact that the talk is amazing, we have to close the discussion soon. So the last question is, like, guys, looking ahead, what would a fully tokenized financial ecosystem in your region look like? and what key milestones must be achieved to go there? David?
I think it's subject to structure. We recently introduced prudential oversight regime for the crypto service providers, such as WASPs. We currently see that the banks are, at least they started to integrate with WASPs to offer the basic functionality of crypto trading. Let's see how it will scale up, and let's see what appetite will they have in the coming future. On the governmental sector side, we see that the government of Georgia have prioritized the tokenization of real estate. Here, you need also a liquidity of fiat. You need also a liquidity in tokenized form of money. Then the question comes of what kind of tokenized form of money will be primarily used. So there is also an opportunity to explore. When we've mentioned so many times stablecoins, but the practice is that I don't really believe that there will be a lot of stablecoins within the economy, because even when we speak about the US dollar denominated stablecoins, there are around three major players, and the difference in their scale is so big that you straight away can see the difference of how the data is advanced in that. So in general, the idea is that in Georgia, we as a central bank are very pro blockchain and pro DLT. It is also supported by the sandboxes that we unlocked for the sector to adopt. And in this condition, we prefer to be less visionary in a context that I can't wait to see how the sector will develop, and I would like to speculate less about my expectations of what should I see in 2 years. But I have my idea. Maybe next time when we're going to speak,
We definitely will speak more, and we definitely will speak in 5 years and see, like, we'll really get this recording and say, okay, 5 years before we said like this, and now it's happening. But Mikhail, like, we still have Mikhail and Jack to go over, yeah?
Yep. So we've already discussed many questions that are really is the milestones for the future. If we are talking about the milestones, we have already discussed them. So the re-legalization and licensing that David is mentioned. Also, the second one is the reliable infrastructure, because without this infrastructure, what we will do? Yep. So blockchain have really good demand, and when we are talking about the transaction per second, it's much more efficient instead of the traditional financing, but still it needs reliable infrastructure. Also, the third one is our today's theme, the adoption of the stable coins. Fourth, I think we've discussed, and I personally said about that, the integration with the current existing financial infrastructure. And the fifth, and not the least one, maybe the tokenization of the real world assets. So, yeah, I think this is the main milestones. We are already adopting them on the Uzbek side. I think my colleagues also are adopting them on their side. So this is the future that we are building right now.
And Jack, your word?
Yeah, I agree with both Mikhail and David, what they're mentioning. I think that on the three jurisdictions, there's a lot of work being done on the entire central bank system, the entire banking system, entire regulation framework for that to actually happen. I think that once the tech is there, which it is right now, but once the banks actually start integrating and the financial services start actually integrating to these payment methods, I think that that's where we're going to see the entire payment flow escalate very fast on the entire cross border. I think it's one of the main use cases, and the P2P markets. So once that takes into consideration, I think the key milestone will be broad listing on most banks within the region, at least the majority of the banks using or enabling a stablecoin payments. And then that will be a milestone that actually will be followed by the use case. So if the banks actually see that that's a use case and that's either a revenue generating vertical for them or actually a distribution model for them, that's where they're going to double click. And yeah, I believe that those are what we are looking for in the next 5 years.
Thank you, guys. I probably will drop like one drop of the wisdom in those sea of wisdom which you shared with us, because from a system integrator point of view, the future, the bright future of all those stable coins and all of this would be much easier for technical implementation if we finally will get cheap ZK proofs, cheap and fast, because that was the key. Like that's the key for the good rollups and for the privacy implementation, which is now kind of difficult without. So you're looking for the business cases and something. I'm looking for the technology improvements to support you guys in implementation of all of this. Thank you. Thank you for your time. Thank you for you sharing your knowledge and your perspective. Uh, we are over. So I have to introduce that the next speaker would be coming after the very, very short break. And guys, thank you and see you in a year probably.
Thank you so much, Sasha.